Next up, I get to welcome back to our stage a good friend and somebody who is now a big shot. I think. Can we get him on the screen? Can we have him moved over here? So, how does it feel? Do you have a throne that you sit on now? What's happening over there?
Not quite. The job really hasn't changed a whole heck of a lot. The liability just has.
Oh, geez,
So
yeah, I
that's
bet.
kind of the way I look at it.
Well, you
But no,
guys,
it's fun.
well, and I should introduce you properly. It's Gary Santos, CEO of Tilt Holdings, new CEO, I should say, TLLTF. Gary, I know you're going to do your thing, and then I've got some questions, and I'm sure the chat will too. But congrats again, man.
Thanks so much. It was something that we kind of thought of when I first joined the firm. I wasn't sure it was going to happen quite this quickly, but I think it just speaks to how fast this company is evolving in front of everyone's eyes. So it's a lot of fun, a lot of work, but a lot of fun.
Awesome, man. Well, all you, I will back off.
So again, thank you for joining me for the Tilt Holdings presentation. As Patrick mentioned, we trade both in the U.S. at TLLTF on the OTCQX as well as on the Canadian Securities Exchange under the ticker TILT. So I want to spend a few minutes just doing a quick overview of who Tilt is as a company. As I mentioned to Patrick, a lot has been changing really since I even joined the firm, which would be back last July. It's been sort of a reevaluation of strategy, a rollout of a new strategy, realignment of our assets, and really, making us into what we think is a different kind of overall MSO. When you think about a number of the multi-state operators out there, they do tend to have a very heavy retail focus. They talk about sales per square foot. They talk about the reach of their sales network. And really for us, we're a little late to that game, frankly. And I think that's because, unlike a lot of the MSOs, we have an entire business unit that's dedicated to non-plant touching assets. And that would be our inhalation and our accessory area. So we do vaporization hardware, the power supplies, the mouthpieces, so the non-filled cartridges, if you will. We also do accessories such as packaging that we're able to bring to that as well. And that packaging is not only for the inhalation products, but also for our cannabis products as well. And then we have a number of traditional cannabis operations over on the East Coast in Pennsylvania, in Ohio, and in Massachusetts. So what we do a little differently, however, is focus on the B2B side of things. And really, I'll talk a little bit more about what that means, because it's really taking that business model that we developed in the inhalation world and bringing it into the plant touching world. So we think it's a little bit of a different twist on what it means to be a true MSO. And we're here to support the LPs. We're here to support the multi-state operators and the cannabis brands, as well as all the independent retail shops that are out there as well. So a couple of quick DNA items here. So in terms of our vaporization capacity, we are the #1 reseller of C-Cell vape technology. So we partner with the owner of the C-Cell technology, which is a company by the name of S'more, located in China. And we are their largest distributor. I think a fun fact on that front is our former CEO and current chairman of the board, Mark Scatterday, was instrumental working with C-Cell to bring that technology into the cannabis space. Prior to Mark partnering with the factory, really their focus was on the tobacco space. In fact, that's where Mark was working at the time, but he was able to take that knowledge and technology and really work with them to develop the ability to bring it to a much more high viscosity concentrate that you see in the cannabis space. So we have about 40–50% or so of the C-Cell distribution market share. We reach out to over 700 customers, and we define customers as the multi-state operators, the Canadian LPs, independent brands. Those are probably our largest customers, but then also some of those retail shops in the states where we have operations. We do have cannabis cultivation operations, as I mentioned, in Massachusetts and in Pennsylvania. We did just add a third site in Ohio, which they're not cultivation, they're manufacturing only, and I'll talk a little bit more about that in a few minutes. We do have sales in 15 countries and 36 states. Overall, our first quarter revenue was just under $47 million. It was a record for us. In the history of Tilt, that was the highest revenue. Also on the adjusted EBITDA front, we did set a record there as well. So one thing I think that's very unique about us in the cannabis space, we have been funding our operation out of cash flow from operations for almost 2 years now. We've not had to sell things or borrow or do things along those lines. It's just been pure blocking and tackling and running an efficient organization. So we are adding, we are profitable. We are adding cash to the balance sheet. So as we look out at the capital markets and we look out at opportunities to grow beyond just organically, but also through M&A and different, interesting opportunities, we recognize that we have a very firm foundation, and we're a little bit different from a lot of folks who are still trying to scale and get into positive EBITDA territory. We're already there.
Hey, Gary, one quick thing for you. Just jumping in. If your slides are moving, we can't see them move. We're on your front. Okay, got it. Just wanted to make sure, man. Go for it. I didn't want to interrupt you, but go.
You blew my jam. I don't know what to do now.
Blew your jam. You're killing it. You're killing it. Hit us with the EBITDA. That was great.
Yeah, no, that's good. So in terms of our capabilities, so in Massachusetts, we are fully vertically integrated. We have cultivation, manufacturing, and some retail. In Pennsylvania, we have cultivation and manufacturing. And as I mentioned, in Ohio, it's manufacturing. So moving ahead, where we see the industry going, and this is really why we've created Tilt the way we've redefined it, if you will. We think that brands are going to find their way into this market once and for all. It's sort of that next generation. I think it's been problematic, obviously, not being able to cross state lines. And how do you get a brand from California over into Massachusetts or Pennsylvania or anywhere on the East Coast for that matter? And how do you keep that brand fidelity? We think that over time, the brands will start to take the place in a fully legalized world. People are going to be looking for brands like they do in just about any other specialty retail business. We also think, though, that when you think about the vertical integration, at some point, I think being fully vertically integrated probably becomes a little bit too much. People always talk about the grow becoming commoditized. I think the retail will start to become commoditized too. And the need to own that entire chain, I think, is going to start to change as more legalization comes along. Now, the devil will be in the details, because obviously we have a long way to go before things are fully legal. And even then, how much authority will the states have and what will that look like? But we've tried to model ourselves to be successful in the current regulatory regime, but then also be able to adapt very quickly and not have a lot of extra overhead that we have to shed in a fully legalized market. So as I mentioned, you look at all of these brands, some of these names you might recognize. We work with some of these, not all of these brands, but these are the types of brands that we would be reaching out to, who have reached out to us even, and we'd be looking to partner with. Because right now, if you think about how brands can come across, either the brands are tied to MSOs directly. Now, in the East Coast, that's problematic, because if you sit in Massachusetts, where I sit, you only have a total of 3 retail stores that you can have. If you're trying to build a brand in Massachusetts, you only have those 3 stores. And then the odds of you as an MSO selling your products to another competing MSO to put in their 3 stores, I think is problematic. And that's why you haven't seen brands take off on the East as you've seen over in California, where it's a much more wide open market. So to bring those brands over, I think the traditional steps have been either the brand gets purchased and becomes part of an MSO, so now that brand has lost a little bit of its independence, or you end up partnering and end up in an exclusive arrangement where you can only be distributed in that MSO stores. So go back to my Massachusetts example, you end up in a situation where, again, you've come east, but you can only be in 3 stores in Massachusetts. So for us, we're offering a completely different animal on that front. We want to be sort of a Switzerland of brands, if you will. So what we intend to do is provide a value proposition that connects all the pieces of our business. So we already work with about 700 brands on the hardware front. So our inhalation hardware, we work with about 700 or so brands on a B2B basis. We provide them products either on a white label basis or on a customized basis that they can put their label, their design on, if you will. And then they go about the business of filling those vaporization pens, and then they go and put them out in their various distribution networks. So we're happy to provide hardware. We're happy to provide packaging. As we look at the plant touching side of the business, however, we want to do the same there. We want to partner with brands. Don't want to buy the brands, don't want to own the brands, because for us, we want brands to do what they do best. Keep the brand fresh, make sure it's relevant, make sure it commands the place in the market that it has right now. So put your time and effort into marketing. Don't worry about the regulatory. Don't worry about the distribution. We'll take care of that with our plant touching operations in Ohio, Pennsylvania, and Massachusetts. So we can offer wholesale flower. We can offer wholesale packaged goods. We can do those packaged goods on a white label basis. Maybe you like one of our products and you just want to put your label on it. We can do custom, bespoke products, whether it's edibles, whether it's flower itself, pre-rolls, whatever it might be. We can do customized. And then we can do product development with you as well, because sometimes brands, what sells in California is not likely to sell on the East Coast because the demographics look a little different. Price and potency tends to carry the day in California, a little less so, I think, on the East Coast. Form factors matter, use cases matter. So working together collaboratively in partnership with these brands to develop a broader set of SKUs that might be more applicable and also fit within the regulatory regime of each of these states. It's a tough road for these brands to try to learn everything about every state they go into. So I think having a partner who is sort of a subject matter expert, understands the distribution and understands the regulatory regime, and then has the capability to provide flower and products and services, I think makes it a very natural partnership. Talked about the hardware and packaging, and then of course the contract manufacturing. So for us, it really is turnkey. If you're a brand, even if you're an MSO, frankly, and there are certain parts of your business that you know it's not a big enough part of your business that you can afford to devote a lot of your time and resources to, but it's something that you'd like to have in your dispensary, I would say reach out to us, because chances are we can do something for you at that level. Whether it's a certain strain of flower, whether it's a certain quality point that you want to be on, whether it's a form factor that maybe you sell a little of, but it's not enough for you to devote a lot of resources, we might be doing it on a broad enough scale that we can get that to you at a cost-effective basis. But the three markets we're in, Pennsylvania, Massachusetts, and Ohio, happen to be three of the most dynamic markets, and growing markets still here on the East Coast. Massachusetts is adult use and medical. It's continuing to grow. I don't think that market has peaked in any way, shape, or form. We've all heard a lot about Pennsylvania over the last year or so, and now that we know adult use is coming, I think that market is really poised to explode, and I think Ohio is sort of coming in right behind Pennsylvania. They're a medical market only right now, but they have a little bit more of a broader mandate in terms of the kinds of form factors we can do there. So we're pretty excited about those markets. We see a lot of growth in those markets, and it's allowing us to create sort of a Northeast nexus on the plant touching side. So a little bit more about our facilities in Massachusetts. It's about a 100,000 square foot facility. A little more than half of that is dedicated to the grow. What's important there is this year we doubled our grow space. So last year at this time, we were about 28,000 square feet. Now we're at 56,000 square feet. We expect to start harvesting some of that new grow space later this year, which is important because we also have 3 retail stores. In Massachusetts, you have to have the retail piece, at least to get those licenses. So we have one of our stores is open right now, a medical dispensary attached to our grow facility in Taunton, Mass. We hope to add adult use there, as well as in Brockton, Massachusetts, a few towns over, medical and adult use, and then also Cambridge right next to Boston, where we expect to have at least medical all up and running before the end of this year. I think an important piece there, these stores are built out. There's no CapEx required. These facilities are up, they're running. And if anything, we're just trying to get more efficient in running those. We did get awards for having the best edible in Massachusetts, fantastic edibles kitchen, as well as an extraction lab. So we can offer pretty much the full suite, the contract manufacturing, white label, our own branded products, and then also a lot of the Jupiter hardware coming in. Pennsylvania, that's a greenhouse grow that we have there. It's a little bit smaller. It's about 33,000 square feet. We've done actually over a million products shipped since inception now. That number has actually been increased over the last quarter. So for us there, the form factor is a little bit more limited. So we don't have a kitchen there right now. We're building one out, but edibles are not allowed right now. So that's more of a future play. But we are able to do all sorts of extraction. We can sell flour. That's one of our big sellers out there right now. So it's pretty much the whole suite of contract manufacturing, white label, and then Jupiter, and our brand there is Standard Farms. It's one of the top brands in Pennsylvania, which is interesting because we don't have a retail footprint there. Instead, we sell into about 95% of the retail stores. So it's a great example of how the business should be working. Keep the expertise in that center, that supply chain management, the specialty supply chain, and the product manufacturing and development, and then distribute to the entire marketplace. And we think that's a very powerful distribution footprint. And then Ohio is the newest entrant. They are just about 10,000 square foot manufacturing facility. We have good lines of sight on biomass. We brought it into the family a little bit sooner than we thought. Right now, they are not included in our guidance to the street, but we do expect to start rolling out branded product later this month, as a matter of fact, and we'll be increasing production throughout the year. So we're pretty excited there. We do have a kitchen. We can do edibles. So already our kitchen team back in Massachusetts is putting together formulations and recipes that they expect to bring out. Then the other side of our business, the hardware, the inhalation hardware, the packaging. The Jupiter is the founder of the C-Cell brand here in the U.S. We are a leader here. We are known for our research and development, as I mentioned, Mark's role in helping bring C-Cell technology to this space. The factory looks to us to do a lot of R&D and partner with them. We have employees on the ground in China at their factory. We have some of more employees on the ground here at our facility in Arizona. So we continue to do work there for them besides being a distributor. We also work with them on all of the warranty work and the service work. So it is much more of a partnership and much less of a distributorship. Again, C-cell cartridges continue to be one of the leading areas in vaporization. I think we estimate, that probably roughly about 70% of vaporization products out there are C-cell brands. And we have roughly about 40-50% market share. So I think that extrapolates to about a 30% market share of all vaporization hardware being sold today. We are a trusted pick, as you can see here. This is the Curaleaf Select line. It is Jupiter hardware that basically feeds it. It's our cartridge, our battery, and then you see Curaleaf fills it with their oil. These are the types of relationships that we have with a number of our partners here. Whenever it comes to putting their name brand, their flagship brands, they do look for that C-cell. It is a bit more of a premium product, acknowledged, but the quality is there, and there's a reason it still commands that premium price. So we're happy to do customized products for all of our big customers along those lines. And that's also helped really bring over these customers into the plant touching side of things as well, because a number of those brands are either looking to get into the markets that we're in on the East Coast, or might be in the market but are in need of product. And we're able to start to cross-sell. Jupiter, as I mentioned, known for quality, reliability, and innovation. We do a lot of testing here, a lot of form factors. Factory has an idea, they shoot it over to us. We do some testing here to see, from a user testing point of view, does it work? Has cannabis oil flow through it? So we're excited and glad to be a meaningful part of that small relationship. So sort of coming to the end here so we can open up for Q&A. If you take a look at where we were in 2020, really it was about getting to profitability. It was about right-sizing the business. We came public in late 2018, underwent some significant management turnover in early to mid 2019. Our board was very active, saying we really need to start to focus on our core competencies and not be one of those wide-ranging cannabis companies that tries to do everything. Unfortunately, Mark and the former president and COO, Tim Condor, were two entrepreneurs that knew how to bootstrap companies from the ground up, and they really cut things back to the point where the foundation became incredibly strong. So if you look back in 2019, where we were just below $1 million or so of adjusted EBITDA, and then we ended 2020 at just under 17 million of positive EBITDA. It really speaks to the strength of those underlying businesses and how they've been profitable throughout, even though, frankly, we haven't been deploying as many resources to those businesses over the years as we should have. That's where we're going today. Same thing with cash from operating activities. We were burning almost 18 million in 2019. We generated almost 17 million in 2020. So it's a pretty massive swing. And it now gives us the chance to really fund our growth internally without having to go out to the capital markets. So when you look at our projections for 2021, which is 205 to 210 million to top line revenue and 30 to 32 million of positive adjusted EBITDA, that's fully funded. It doesn't require any massive CapEx, doesn't require M&A. We're not waiting on deals to close. This is just existing assets that we're leaning into. And honestly, even by the time we get to the end of this year, I'm willing to say that they still will have much more room to grow until they're really maximized out and fully efficient. So, I think, the canopy expansion is a big piece of that growth. I think we're seeing a return to normalized purchasing in the form of the vape technology that sort of died away a little bit coming out of 2019. We had the vape scare, and then also we rolled right into the pandemic. What we saw at the end of last year into this year now has been a much more of a return to a normalized vape growth. I think BDS puts out about 18% is where they expect to see vape as a category grow this year. I think we're on pace to exceed 25% or more growth ourselves. So in terms of overall highlights, we are multi-state, we are international, we do sell B2B. We do have a lot of turnkey plant touching assets that we think gives us a much more wider spectrum of product offerings to really be a B2B solutions provider. We are the backbone of the inhalation industry. We are fully funded. So between cash flow and access to the capital markets, we are well positioned to grow today and beyond. And we really have some great expansion opportunities, I think, to enter additional markets. So with that, I think that ends the prepared remarks. Patrick, if you want to jump in and maybe do a little Q&A.
Yeah. I think we've got about 1 minute. So I'm going to hit you with a couple here really quick. One of the things that you and I have spoken about over and over again is the fact that Tilt got kind of a second act, right? And when you when you came in, you know the markets, you know this industry, right? And I wonder if there's anything you can sort of land on as the one thing you were interested in doing to jumpstart the business, because it definitely seems like paring back and being more efficient with capital was the way to go. But the results are showing, right? And the just the overall margins, the EBITDA, it's all trending positively. So anything you wanna touch on there?
Yeah, I think for us, it was really just taking a look at our strengthening that foundation. But I mean, you can't cut your way to profitability, right? So, but you also can't just spend your way to profitability. You have to sort of thread that needle. And that's really what was interesting to me about Tilt. The bones were so strong. You could look at these underlying businesses, and there were certain things holding them back, and how they allocated capital, which businesses they were leaning into, I think were important. And it was a time when the whole market was sort of going through a bit of a reset. If you think about mid 2019 into 2020. So, while we are a little bit behind where some of the other multi-state operators might be, I think we've approached the business much more efficiently. So we are able to say we're profitable now. And as we look towards adding capacity or going into new areas, we're very intentional about what that means. It's not just about top line revenue. If I can get better revenue streams without having to take on all sorts of expense, if you think about partnerships as opposed to just building something de novo, that could be much more attractive because those things tend to be much more additive to the bottom line. You get the same bang for a lot less buck. So I think that was one of the things that was really attractive about Tilt. It's great that we have a board that has really bought into that, and I think their expertise in identifying the fact that you can't buy your way to profitability and stay true to that strategy has been key. And just having the team and the depth of team to be able to do that deep dive and be willing to take a real look in the mirror. It was hard to turn to the then CFO and president and say, I think we need to pivot away from one of the businesses that you started. And to his credit, he said, I completely agree. So I think it speaks to the team and it speaks to the strength of the company.
Very cool. Very cool. Well, listen, I have to highlight this one thing before I let you go. Jose Fernandez asks us, can you ask him if he thinks it will tilt up or tilt down? And, what Jose doesn't know is that generally when you're at home, you have a hockey stick behind you. That shows us exactly which way it's going to tilt. Exactly. Up, Jose, up.
It better tilt up. Otherwise, it's going to be a short run to me as CEO. So.
Good, man. Well, thanks. I really appreciate you coming on. And those folks in the chat, if you want to email events@benzinga.com, we actually have a longer form of this deck that we can send you. And it's also posted in the Tilt booth on our networking platform for anybody on there. Gary, with that, I'll let you go, man. It's great to see you.
Pleasure as always. Thanks so much.
Take care, man.